everyone. It certainly is lovely to be back in Windhoek, and I'm happy to be here with you this morning. So I hope what I have to share will provide you with some encouragement of where we are with the Namibian economy at this point in time and the outlook that we have going forward. So my job this morning is to provide you with a broad overview of where we are, where the economy is at the moment, and what is our outlook? Where do we see our economy going forward? With this in mind, there is also a focus on the financial position that the average consumer in Namibia finds him or herself in at this point in time, and which indicators we sort of look at to assess that. So without spending more time, I'll first start off by looking at a few macroeconomic indicators, just to give a broad macroeconomic overview, and then I'll move over to the consumer environment later on. So I'm sure most of you have already seen this graph many a times, but I just showed here to provide some context. So this is our annual GDP growth figures, trying to tell us, to paint a picture of the performance of the economy. And you can see towards the right end of the chart, we are certainly recording economic growth rates that we have not seen since 2015, when government embarked on a fiscal consolidation path. So obviously that low base that you see there in 2020 has a lot to do with that. We are coming off that low base, so naturally that statistical or mathematical base effect is helping our growth figures to look much better. But there certainly is a lot of momentum in various industries that we are quite positive about going forward. So what is driving this growth? It's your usual sectors such as mining, utilities, transport, hotels and restaurants, wholesale and retail. Those are just some of the top performers. So these figures come from the first quarter of 2023. It's the latest data that we have available. And we remain positive in quite a number of these industries going forward. Mining, we still see a lot of investments and exploration taking place in our usual commodity markets, such as copper, gold, and uranium, but also new commodities that are new to the Namibian commodity export market basket, and that includes rare earth metals and lithium as well. So we are confident that Sorry, can you hear me better now? So we are confident that the explorations being done now and the expansions of the mines that's being done at the moment will lead to higher production between 2025 and 2026. So that is still at least in the very short to medium term. And naturally, the last time Namibia exported lithium was in 1998. Since then, we've never had lithium. Lithium actually started in 1932 in Namibia. So that will be a new commodity that we are adding to our basket. So certainly something very positive, something to be positive about. But once again, mining being very capital intensive is not necessarily creating a lot of jobs, which we need at this point in time. Electricity and water, we're still positive on electricity. I've recently moved, as Lara said, to Cape Town for my new job that I started there. And I must say it's quite something to get used to the load shedding schedule. A lot of times I have to go to a bar and get food there because I can't cook at home after work. And I think that's something Namibia can still be very grateful for. And that's a big positive for our economy, because at least business activity is not negatively impacted by power outages or disruptions. That is obviously coming at a cost, because Namibia is the only Southern African country that does not have power outages or disruptions in one form or another. And that's obviously coming at a cost. So that's why we have the most expensive electricity in the region as well. But it still is a positive for business activity nonetheless. Transport, I'm very positive about. Load shedding in South Africa is preventing their ports at Durban from working properly. Theft and vandalism on the railway network also prevents the trains from working properly. So a lot of landlocked Southern African countries are now sending their cargo through Namibia to Walvis Bay for exports on ships. So both your local truck companies are very positive about the current business environment, stealing market share from South Africa, transporting commodities on their trucks that they never transported before. And then obviously it will also benefit Namport as this cargo is going to Walvis Bay for exports. So I'm very positive on that. And that's leading to an increase in commercial vehicle sales as these truck companies are expanding their fleet. But I'll touch on that later. Hotels and restaurants, a very poor proxy for tourism, because tourism is a lot more than just accommodation and restaurants. You have air charters, you have hunting guides, you have tour operators, you have travel agents, you have car rental companies. Tourism globally and in Namibia has one of the widest value chains as an industry. And interestingly, one job in the tourism sector in Namibia supports or creates 12 other jobs in other industries. No other industry has that high number. All other industries, it's between 3 and 6 jobs that they support, whereas tourism is at 12. So really, we are very positive on that. Recessions in Europe and America has not come through as initially expected. So your rich Europeans are still going to travel to Namibia if they want to travel. So we do not see that as a big risk to tourist inflows. Maybe the recent Menzies debacle at the airport is probably still a bit of a risk, but we remain positive of seeing an improved tourist inflow that will definitely support the local tourism sector. Wholesale and retail is a funny one. Given the current environment, we would have expected retail sales to be on a negative trend, but it's actually still performing quite well. You can see that it's one of the top 5 best performing sectors. But I'll touch a bit more on retail later on when I get to the consumer environment. We remain negative on agriculture, construction and manufacturing, education and health. That might also start normalizing as government spends less in those sectors following the pandemic, when they spent quite a lot in those sectors. ICT, we're still positive on. And then financial services. You can see there the worst performer still, mainly driven by a decrease in insurance premiums and policies being extended, according to the NSA's data. So my personal opinion is that we might have seen the worst. The worst is probably behind us with the financial services sector. So going forward, we do expect that to start showing signs of recovery as well. So just to get an idea of where the economic recovery is. So remember that big drop in economic growth rates that we saw in 2020 in the first chart. We still need to recover from that. So what I try to do here is I show the economic value in Namibian dollar terms of all these different industries in the first quarter of this year, and I compare that to the economic value of the first quarter in 2019, sort of as a pre-pandemic benchmark. And I take the percentage thereof. So if an industry's blue bar is above the yellow line, it means it has either reached or surpassed its pre-pandemic level. You can see there quite a number of industries still remain below their pre-pandemic average, but you can see most of them are all above 80%. So what that tells me is that, what this picture tells me is that most of the economic recovery from the lockdown-induced recession in 2020 has already been achieved. So we are most of the way there to getting back to where we were pre-COVID. But obviously some sectors still have room for improvement, and that we then definitely see recovering probably towards the end of this year. We should be back at pre-pandemic levels. We have good economic growth rates. The numbers look good on paper, and it's something to be positive about. But from my engagements with various companies and stakeholders in Windhoek and other areas in Namibia, I'm not convinced that we have recovered all the jobs that were lost during the lockdown. I always say the lockdown because it's not the virus did not cause a loss in jobs, it was the lockdown. That's the reason for the economic loss, not some virus that was floating in the air. So from the lockdown-induced recession, I'm not sure we've recovered all the jobs. And remember, before COVID, we in any case had very high levels of unemployment. So we can achieve good economic growth rates by employing equipment and technology, and certainly the lockdown and people working remotely from home, that forced a lot of companies to adopt technologies to do the jobs remotely, and that replaced a few people. My understanding is also that a lot of large corporations in Namibia have let go of some staff members, but they were never replaced. So their duties and responsibilities fell onto existing staff members who were left behind at the company. So in that sense, you have a lot of staff members being overworked at the moment, When I engage with a few people, a lot of people tell me just how tired they are because of this situation. So we can have good growth rates without job creation taking place, because at grassroots level, we are not convinced that a lot of job creation has taken place. And funny enough, some industries still have salary cuts till today that were implemented in 2020. And now you're sitting with a massive inflationary, not a crisis, but really a much, living costs have become much more expensive. But we're not too convinced that salaries have recovered or jobs. And I think that will also lead to other problems, but at least the numbers look good for now. So looking at the various components of GDP, at the very basic level, the GDP calculation is equal to consumption plus government spending plus investment plus net exports. If you look at consumption, which is this top blue area, you can see there it's already started slowing down from the highs that we saw at the start of last year. But interestingly, real consumption spending, in other words, consumption spending adjusted for inflation. So if I take price times quantity, I keep price constant, and I only look at what's happening with quantity. That is still growing at double digits. It grew at 14% in the first quarter of this year. So people are still physically buying more than they did 12 months ago, despite the inflationary environment that we're sitting in. But I'll get to that one later on. The yellow area being government spending. As a result of improved economic growth rates, we expect tax revenue to improve. Also, Sam Shavute being very aggressive with his team at NAMRA in tax collections. So we do expect that to also be a positive for government's revenue. So that can allow the government to start spending more than what they've been used to in the last couple of years. And why that is important is because government is estimated to be between 60 and 70% of our economy. So that's a big player in the economy. So if he starts spending more, that will automatically lead to further benefits. Obviously, if the spending is done efficiently and it's well targeted, and that's probably just a nice way of saying less corruption. So the dark blue area being net investments, we are positive on that going forward as well. We're seeing a lot of foreign direct investment, not in the just in the mining space, but also in the energy sector. If government can finalize and implement its special economic zone bill, then we should see improved investment in other sectors of the economy as well. So we remain quite positive on that. The only negative component of GDP would be this orange area, which is net exports. Unfortunately, the weak rand exchange rate is still inflating our import bill above the export bill, despite an improvement in mining production, because our commodities and fish is about 80% of our exports, give or take. So despite an improvement in mining production and increasing our exports, the import bill is still inflated as a result of the weak rand-US dollar exchange rate. And we expect that to remain negative on GDP. But basically, 3 out of the 4 components should be positive for the GDP calculation. And that's why we remain positive on seeing sustained high growth rates going forward. So, just to touch more on investment, what I decided to show you this morning, given that we have a lot of representatives from the financial services industry, I decided to show you the credit extension or loan advancements from local commercial banks. I compare it to South Africa just because our economies are fairly similar, but also just to show, are we underperforming or sort of overperforming, just some kind of a benchmark. On the left-hand side, you can see overall credit extension being very low. Pre-COVID, our long-term average was about 6 to 7% annual growth every month. Now we're doing roughly 2 to 3%. At least that's also my forecast for 2023. In the middle, you can see what's very interesting is that corporate Namibia they are net repayers on their debt, because you can see their credit extension line being below 0, so it's in negative territory. And we see only installment credit really being a driver of corporate credit in Namibia at the moment. And I think that speaks to transport companies expanding their vehicle fleet, but also mining companies buying more equipment for their exploration and so forth. On the far right-hand side, you can see household credit extension. That's increased and recovered quite significantly. And we see a recovery in mortgages, as well as installment credit, which is typically car loans, and other loans and advances, which typically, according to Bank of Namibia's data, includes credit cards and personal loans. What And that's driving that number higher. What is interesting, though, is that households are net repayers on their overdrafts. And that is since last year. And I find that quite interesting. But overall, we do expect corporate credit to recover from next year onwards. The banks tell me that they have a strong pipeline of bankable projects in the mining, in the energy, tourism, and transport sectors that they then expect to come through next year. So that will then also drive investment higher. I hope, is this my time at the bottom? Has it really been 30 minutes? Left. Oh, okay. I got a fright now. Okay. So yeah, then I don't have to rush myself anymore. So we are expecting that to then filter through to higher loan advancement into the private sector. We expect household credit to also just remain relatively flat, so still somewhat supportive of loan growth from the banks going forward. And that's mainly because of car loans and home loans, which I will explain why later on. So that should then support credit growth to the private sector going forward. And we need that because if you don't have investment taking place, it will hurt future growth down the line. And also, I don't show that graph here, but if you look at the data from the NSA, you'll see that net investment in the Namibian economy is growing at a slower pace than the depreciation of fixed capital in our economy. So what that means is that there is a lack of investment, and investment is not growing fast enough to maintain the growth that we have now, but also to benefit future growth further down the line. So we do need to see a pickup in that as well. So that's sort of some of the macroeconomic indicators, somewhat of a more positive story than what some of you might be used to hearing from economists in Namibia. Obviously, that does not come without risks, but I'll touch on that later on. For now, let's stay on the positive side of things. So now I'll just look at some indicators that are more relatable to the consumer or the average consumer. The idea with the next section really is to understand what environment does the average Namibian consumer find him or herself in at the moment. So the first one is food prices, obviously very important for all of us. And I show the global food price index from the United Nations here. And you can see towards the end of this graph, it is showing signs of a sharp normalization. So globally, we are seeing food prices on a declining trend. There are still some risks here and there, adverse weather conditions impacting harvests in various countries. The most recent example is sugar and rice. So there are still some risks, but overall, food prices are on a downward trend. Now, why is this important for Namibia? It's because we import about 60% of our annual food requirement. Namibian farmers only provide roughly 40% of the food that we consume on an annual basis. So what's happening with global food prices is very important for us. Obviously, the rand exchange rate as well. But at least you can see there that the sharp uptick that we saw last year as a result of the war in Ukraine, that's sort of started to normalize already. What does this mean is that food prices are still likely to be increasing. But the pace at which it increases might not be a strong double-digit number anymore. It might not be 30% or 25% anymore. It might now only be a high single digit. Or according to the NSA's official numbers, it was about 14, 13, 15%. But obviously, if you shop at Spar or Checkers or Woolworths for that matter, you are looking at probably 30% food price inflation. So what we're trying to say is that prices will still be increasing, but just not by as much as what we were used to last year. Shipping costs globally. Oops, sorry, I forgot the sensors there. Globally, we also see that your supply chain pressures are easing significantly. On the left-hand side, this line shows the reports of product shortages globally. And you can see that's already normalized back to its pre-pandemic level. On the right-hand side, it's just sort of a general index measuring supply chain pressure, but supply chain costs or shipping costs are also part of that index. And you can see there that's also normalized quite significantly towards the end of the chart. So when I speak to a lot of companies in various industries in Namibia, they all tell me that their shipping costs, just to import products on a ship that comes to Walvis Bay's port, those shipping costs have decreased by between 70 and 80% from its pandemic peak. Just to give you an idea of that, before the pandemic, a normal company would have maybe paid about $3,000 for a container of, let's say, your Obeku and you're importing toilet pots and tiles. It would be $3,000 for one container on a ship. After the pandemic, that went up to $24,000 per container. So that's an 8-fold increase. But then from that peak, and it's sort of similar for many other companies, it was between 22 and 24,000 when I surveyed about 20 companies in different industries here in Namibia. But they all tell me that it's now decreased between 70 and 80% from that peak. And why is this important for us as a consumers? Because most of the products we buy on a daily basis are imported. We don't manufacture our own products that we buy every day. Furniture, cosmetics, clothing, you name it, electronics and so forth. So if the shipping costs are coming down, that means that all the products we import can at least also start seeing some declines going forward. Once again, though, the risk here is your weak rand US dollar exchange rate. Because if that's not strengthening, then you might not see the full impact of lower shipping costs. But at least to some extent, it is filtering through to lower consumer prices for us. Globally, we see the factory orders on a declining trend. So I just show some of the major manufacturing countries globally on the left-hand side. And you can see there that their factory orders are on a declining trend. This is more backward-looking. More forward-looking would be the Manufacturing Purchasing Manager Index, the manufacturing PMI. That is a survey that gets sent to managers at manufacturing companies, and they are asked how do they feel about their current business environment, where do they see their business environment 12 months from now, how do they see their number of clients, number of orders 12 months from now, and amongst many other questions. So that's why the PMI is more forward-looking. But you can see there for all those major economies globally, their manufacturing PMI is below the critical 50 index points. What that then tells us as economists is that we can expect contractions in manufacturing production over the next 12-month period. It's just India sort of doing positive there. India is now a new hotspot for global factories to relocate out of China. Other beneficiaries of that is Vietnam, amongst others. So they are still positive, but the rest is all negative. And this decrease in factory orders is as a result of retailers in advanced economies sitting with excess stock at the moment. Because once your supply chain pressures eased, you suddenly had a large influx of stock which you were waiting for a very long time. So now retailers are sitting with excess stock. That's also what's helping them to lower their prices. But it means they're putting in less orders from the factories. And that filters through to lower commodity prices. So here I show the metal prices of some metals that Namibia actually also exports since the start of this year up until now. For some, it's still on a positive trend, but for most of them, they're actually on a downward trend. On average, global metal prices in US dollar terms are down by between 7 and 8%. That's bad for miners, but the weak rand exchange rate somehow offsets the lower US dollar price of their metals that they export. But for consumers, this is actually positive because it means that the metals that are used in the manufacturing process of electronics, cars, furniture, any kind of merchandise goods that we import and buy on a daily basis, those prices can now then also start to decrease. So this is a positive for consumers, and it's as a result of less factory orders that we see across the world. So this should then also start to benefit consumers in Namibia in the form of lower merchandise goods prices. And that's why we remain positive on overall inflation continuing to moderate in Namibia. We are forecasting 5.9% average inflation for 2023, slightly lower than the 6.1% that we saw last year. Now, that is the headline inflation number, the thick blue line that you see here. But what's very important in this graph, it's a bit messy, but these are just some of the main categories in our consumer price basket that's used to calculate our inflation rates. What's critical here is now I might be a bit colorblind, it's this line here. This sort of green-blue line. that's below zero at the moment. That's the transport category. Fuel prices is sort of the tide that lifts all boats because of the widespread use of fuel, petrol and diesel in the economy. So we've seen very flat to slightly negative petrol prices or fuel prices rather for Namibia in 2023. And that's why we see that line being below zero. It's actually in deflation territory. And that's also assisted our overall inflation figures coming in much lower. There is a risk to that, however. Global oil prices are expected to increase from their current levels because of supply cuts out of Russia and Saudi Arabia. You have flooding in Libya that's also decreasing their daily oil production. You have oil fields being shut down in Kazakhstan because of maintenance. So all these factors out of these major oil-producing countries should lead to lower supply of oil, and therefore the price should then increase as well. At the same time, we're sitting with a very weak rand exchange rate, which will then also put upward pressure on local fuel prices. So I am expecting fuel price hikes to be announced in the next couple of months, and that then definitely is a risk to our inflation outlook. But for now, we still expect it to continue moderating. Once again, it is coming off a very high base from last year, so that mathematical base effect should help inflation to then also come in lower for 2023. But what I wanted to stress again is that what does lower inflation really mean? It still means prices are increasing, but it's just not the pace at which it's increasing is smaller. So prices might not now be increasing 10%, 12% on average. Now they may be only increasing 8 or 9%. So the pace at which it increases is just smaller. So although we forecast lower inflation rates, that does not steal from the fact that consumers are still faced with very expensive living costs at this point in time. In addition to very expensive living costs, we now also slap on higher interest rates on our consumers. So what I show here is the repo rate from Bank of Namibia, which, as you know, influences short-term interest rates from commercial banks that they charge to their clients. And then I also show you the votes of the 5 members who are responsible for these movements in the repo rate. What's interesting is that one of the 5 MPC members, the Monetary Policy Committee members, was always more aggressive and always voted for a much higher rate hike than the 4 other members. But luckily, the 4 other members are more conservative, and that's why we've not seen a sharper increase in the repo rate. Going forward, we are of the opinion that we've reached the end of the current rate hiking cycle, and we therefore don't expect any more rate hikes from both the Reserve Bank in South Africa and then also Bank of Namibia locally. But interest rates will still likely remain very high for quite some time. We only see interest rate cuts from the second half of next year onwards. At the moment, we still have a 50 basis points difference between the 2 repo rates, South Africa at 8.25, Namibia at 7.75. We expect that differential to remain in place until the Reserve Bank starts to cut their repo rate. Likely, it will be that Bank of Namibia waits for SARB to cut down to 7.75, and only from there onwards, Bank of Namibia will follow rate cuts from South Africa. That's at least what we are expecting at this point in time, but obviously these things are quite quick to change. But at least for now, some sort of relief for consumers is that we do believe we won't have any more rate hikes. Come this Thursday, when SARB announces their latest decision, then you can see if I'm proven wrong, but let's wait and see. I find this picture very interesting. I saw it done for America, and I thought to do it for Namibia as well. So what this graph shows you is all the previous rate hiking cycles that we've had in Namibia since independence. What some of you might remember, I was only about 5 years old in 1998. But what some of you might remember is that in 1998, Bank of Namibia increased the repo rate by a total 525 basis points. That you can see on the y-axis. So the y-axis measures the magnitude, the size of the rate hiking cycle in basis points of the repo rate. And what's interesting, I mean, even just in one meeting, it was raised 200 basis points. So that's a massive shock to any household's budget, no matter if you're rich or on the lower income spectrum. If we look at the current rate hiking cycle, it's this orange or pinkish line with the arrow at the end. It's the second largest rate hiking cycle that we've had since independence. A total cumulative 400 basis points increase in the repo rate, which started in December 2021, and which we believe has now come to an end as well. But if you look on the x-axis, there we have the number of months. So that tells us how aggressive the rate hiking cycle was. The repo rate increased by over 500 basis points within less than 5 months in 1998, quite aggressive. And then you see a bunch of other rate hiking cycles also of a smaller magnitude, but also within a shorter period of time. The current rate hiking cycle lasted 17 months. So not as aggressive as what we've had in the past. So what does this picture tell me? On the one hand, you could probably say, well, the average consumer has lived through worse. We've experienced worse and they've made it through, they've survived. So, they can survive this one as well. But then on the other flip side, we can also say in these years, we had a much stronger economy growing at much higher rates. We had a boom period from the late 90s to about 2010, 2012, before global commodity prices crashed. So those were our economic boom years. Jobs were being created, we had low unemployment, salaries were increasing by more than inflation. We saw house prices increasing strong double digits. So it was a very good time for Namibia. The current rate hiking cycle takes place in a different environment where we've had low economic growth since 2015. We have much higher unemployment, alarmingly very high youth unemployment, which we expect is anything close to 60% at this point in time. The latest official figure was 46% from the NSA's labor force survey in 2018. They couldn't do more labor force surveys because of lack of funding and budget cuts from government. So we have to rely on those old figures. But we're sitting with much higher unemployment, and at the same time, we have a massive economic loss as a result of the lockdown that was put in place in 2020, that we have still not fully recovered from, especially in terms of jobs and salaries. And then on top of that, we also have a very high inflationary environment where we have expensive living costs and high interest rates. So this current rate hiking cycle definitely cannot be treated very lightly, despite it not being as bad as what some of you in this room have lived through in the past. And just an interesting point on youth unemployment, the United Nations estimates that the average, sorry, before I say that, I told some of the TransUnion colleagues earlier that they asked me, but why did you change jobs? Why did you now move to Cape Town? Well, I mean, it was a good opportunity that I got, and I guess at some point I also need to leave my parents' house. So I turned 30 this year in June, and I've been living with my parents since I came back from university, and when I started my first job here in Windhoek. But I mean, at some point I also need to leave my parents' house. But on that point, the United Nations estimates that the average young Namibian will be financially dependent on his or her parents until the age of 27. I think that's probably still conservative. I mean, I know a lot of youngsters. I've engaged a lot with NAST and UNAM with presentations, and it really breaks my heart that a lot of young people close to my age tell me, but Theo, I've been unemployed for the last 5 to 7 years. So I think that 27 is still quite conservative. I would probably say it's at probably 30 to 32. I mean, I myself am 30 and I still lived with my parents 3 weeks ago. So I think that really is sort of the environment that we sit in. So your average consumer who is hopefully employed is not just battling his or her own high inflation, high interest rate environment. They still have an unemployed child who's probably educated with a university degree, who they still need to take care of. So I think that really is quite a tough financial position that the average Namibian consumer finds him or herself in at this point in time. But despite all of that, we still see very high growth in retail sales. Remember the second graph that I showed you of all the industries on the left-hand side? You saw there that wholesale and retail was the fifth largest or best performing sector still, which is strange because we would expect people to cut back, budgets are under pressure, so you would start to spend less. Your interest payments on your debt is more, so we would expect people to spend less. But that's not what we see. And if you look at this graph, this shows total vehicle sales on a monthly basis. These figures include both passenger vehicles, which we as normal individuals will buy, and also commercial vehicles, which obviously truck companies and mining companies and so forth would buy. And what you can see here is a strong recovery after April in 2020, when most dealerships were sort of closed as a result of the lockdown. And what's more interestingly is June of this year, the third largest, latest data point we have there, was over 1,300 vehicles sold in the month of June alone. That is the highest number of monthly vehicle sales, that we've recorded since mid-2017. So it's even better than 2018 and 2019, which are fairly normal years. It's pre-COVID years. So that actually says something. And when I talk to most of the dealerships, from Kia and Toyota and Nissan, all the way to Volkswagen and BMW and Mercedes and Land Rover, they tell me that before COVID, they did about 60% loan sales, 40% cash sales. After COVID in 2021, that went to 70% cash sales, 30% loan sales. At the moment, when I spoke to some of the dealers earlier, a few months ago, it's now more or less 50-50. Some it's 40-60, where 40 is cash sales, and where they're back to 60% loan sales. Banks see cars as a high risk at this point in time, so that's probably why more people are buying cash as well. But if you're buying a $1 million BMW cash, you have to, in the current times we're living in, you have to ask yourself, where's this money coming from? The graph that I don't show here, just before I left Simony Storm, on my last day, I decided to leave with a bang. So I released a big report that I did on Namibia's property and housing market. I've engaged with a lot of real estate agents in various towns, but mainly also in Windhoek. The general story from them is that there's a significant increase in demand, both for house purchases, but also for rentals. The people driving this demand is mainly foreign nationals, which come from Germany and the US, a bit of Belgium as well, but then also South Africans. I think clearly South Africans see the lights are still on here, so they decide it might be better here. But then what's also part of the story, or this increase in demand, is actually locals themselves. Angolans do play a small part of it as well, but it's more the foreign nationals, South Africans and Namibians. And that's why we see an uptick in house prices since the end of last year. FNB is the only company in the whole of Namibia that has the deeds office data electronically, and we've analyzed that, and there we see a clear uptick in house prices as well, because we still sit with a shortage of in the supply of serviced plots. And that's why house prices, we expect to continue remaining on an upward trend, especially with all these foreign nationals coming to our country. And what's interesting is I spoke to prominent real estate agents in Swakop and Windhoek, told me that they see an uptick in cash sales as well of houses. The one estate agent in Swakop, she told me she's doing up to 80% of her sales in cash. Only 20% of her clients are using loans. And the one prominent agent here in Windhoek said about 60% cash, 40% loan sales. Now, that's not the case with all agents, but there are quite prominent agents, and that's why I think it's just an important point to mention. So once again, you have to ask yourself, retail sales is doing well, people are spending more, people are buying cars and houses, and quite a lot of Namibians are buying them cash. Where is all this money coming from? Because clearly things then can't be as bad as what we economists typically think. I think a big part of the story has to do with a few cash injections that we've seen in the economy in the last couple of months. Between the second quarter of 2020, I use the second quarter because the lockdown started end of March. So I go from the second quarter of 2020 onwards up until the first quarter of this year. A total of just over 22 billion Namibian dollars have been paid out from life insurance policies. Now, you will know very well that these are tax-free benefits that are paid directly to the beneficiaries of these life insurance policies. So you're putting a lot of money directly into the pockets of people, and we don't have a saving culture in Namibia. We like to spend. So that money has to go somewhere. And 22 billion is quite a lot of money, especially since the government isn't getting a cent of it because it's tax-free. The other one that I thought of was Namibia Breweries that paid a special dividend in April this year. That put about 340 million Namibian dollars directly into the pockets of normal individual investors. So that's excluding the pension funds and the asset managers, just normal individuals. 340 million special dividend from Namibia Breweries. And obviously that money must also go somewhere. And I think that can partly explain why we still see a very positive picture for retail sales at this point in time. But now we must also remember Namibia is one of the most unequal countries when it comes to income and asset ownership. So it's not your lower middle income individual or household or your low income household that might have shares in Namibia Breweries to get that special dividend. Maybe they also don't have a very sizable life cover policy or funeral cover on their family members. So where did most of that money go to? I would suspect, and I have no data to back this, so any criticism is welcomed, but I would suspect that most of it went to your upper middle income to high income families or consumers. High income individuals, especially typically being very old Germans in Namibia, don't typically spend a great portion of their money. So there are some arguments against these cash injections that I've touched on. But I guess because we don't have data, we can't really say. But I think that nonetheless still supports this positive momentum in retail sales that we see. And then another picture that I have where I now actually have data to show you is this light blue area that you see here at the bottom. This is the total assets under management in your money market unit trust funds. There are many other funds there as well, equity funds, managed funds, fixed income funds, property funds, and so forth. But I focus here just on the money market fund. You can see here, since the data starts in 2006, in nominal terms, in other words, not adjusted for inflation, your money market funds have the highest assets under management since the data starts. At the moment, it's about 55 billion Namibian dollars. That's quite a significant amount of money because that's more or less government's total revenue, total tax and total non-tax revenue put together. In the last couple of financial years, government revenue was about 55 to 58 billion. So that's a very sizable amount of money because what does that mean? If these private investors withdraw all their funds from the money market unit trust fund that they have, they can essentially pay or cover government's total revenue for one financial year. So some of this might be invested in pension funds, but not a great deal because money market is very low risk, very conservative. It's not going to grow your pension. So most of this, I suspect, would be normal Namibians who have a call account with a bank, and the call accounts obviously typically invest in your money market unit trust funds. And other financial companies also provide call accounts that are invested in money market funds. So this tells me that there's quite a lot of money that some individuals can draw down from to help them cover their living expenses and their interest payments and so forth. So there is some sort of safety net. But once again, you have to ask yourself, do lower income individuals have a call account that's invested in money market? And even if they do, is it more than 10,000 or 100,000? Not really. So this private safety net might also only be there for your upper middle income class and then your high income class as well. So your lower middle income and low income consumer does not really have much of a private social safety net. Now, yes, government increased social grants, and we all complained it's only $100. What's that going to do? But if you look at how many all the thousands of beneficiaries that there are, that $100 is actually, it adds up to a very large amount on a monthly basis. So at least that can also be a lot more money being injected into the economy in the form of spending. So nonetheless, that's why we are actually still cautiously positive on consumption spending going forward. But I think you once again, for your businesses and your clients and so forth, you need to be aware of the big inequality that we have in Namibia. Because those who don't have a safety net, they are being punished by higher interest rates because they are typically more indebted than higher income individuals who are typically debt-free. Also, higher income consumers who save and invest, they are benefiting from higher interest rates because their savings is just growing at a higher rate now. But your lower income individual, they are suffering with higher interest payments with the debt that they have. The last time I did the calculation, it's a very basic calculation and probably understated, but on average, the Namibian household would have about between 6 to 8 months' salary in short-term debt. I'm guessing it's probably a lot higher than 6 to 8 months, but just to give you some rough idea. So I think that will then also entrench the high inequality that we have in Namibia, if not even further widening it. Because we are also not convinced that a lot of job creation has taken place, and we're also not aware that, in our view rather, we don't know if salary increases have taken place to really help the average consumer in Namibia. So I think that you should just always be aware of. My last slide just looks at some of the regulations affecting Namibia, and I see my time is almost up. I have 10 seconds. But I think these are positive developments. It's about time that government increased the minimum taxable income threshold from 50,000 per annum to now 100,000, although that's only effective from April next year. But this should free up quite a bit of disposable income, especially for your low-income earners, who in any case typically spend most of their salary. So then government could actually benefit through VAT income. So although you get less personal income tax, it might be offset by higher VAT, because obviously most of the money will be spent, given our culture, but also given the MPC, the marginal propensity to consume that I've calculated for Namibia, which says that for every $1 Namibian earned as a salary, 69 cents is spent on the dollar, and only about 31 cents is saved. So I think that the first one will definitely lead to an increase in consumption spending, especially for your low-income earner. The second one, with corporate tax being reduced by 1 percentage point over the next 2 financial years, I think that's also positive. It should free up more profits for companies, hopefully trying to use that additional profit to either employ more people or to just expand their business and thereby benefiting GDP growth as well. The third one, I actually already discussed. The last one is a bit of a funny one, but I really couldn't think of anything else. And I think that will also just help. I mean, I don't think it's a wise financial decision to buy a car that's older than 8 years, with the limit being lifted from 8 to 12 years, just because of the maintenance costs and the financial risks that come along with that. But at least for low-income earners, it would be slightly more affordable for them to buy a car because it's older as well. One thing that I would add here, but it's not been done, but I really am still a strong proponent for it. And there's actually young, educated people in Ministry of Finance fighting for this since 2016, more or less. But they're still not getting through with their managers. And that is that our tax brackets need to be adjusted for inflation. It's a common thing that gets done in almost every country across the globe, but we, for some reason, don't do it. With the new research and policy research unit, FEPRU, coming up in Ministry of Finance, the idea is for them to start doing research on this, how to do it, and then advise government on how they can practically go about and do it. So I am positive that hopefully it can come fairly soon. But that is really something that will also help the average Namibian consumer. Because these days, getting a salary increase, you don't really see the full benefit of that. To put it in perspective, when I still worked at Simony Storm, our cleaner is eligible to pay tax because she earns more than 50,000 per annum. And that should not be the case. Your gardener should not be eligible to pay tax. That just doesn't make sense. But it's because our tax brackets are not adjusted for inflation that our years and years of getting a salary increase, we are pushing low-income earners who are at the bottom of society, or sort of the lower class, if I can call it that, we are pushing them into tax brackets, which should not be the case. So if in your personal sphere of influence, if there's one thing that you take away from today, go and fight for that with whoever you can. My last slide, and then I really am done. So these are some of the forecasts that we have on a few indicators from Oxford Economics, Africa. So you can see there the top line, real GDP, we still forecast 3.1% in 2023. Yes, it's lower than last year, but it's still much higher than what we are used to. And we sort of see that slightly flattening out a bit until 2026. Inflation, we are forecasting to also continue moderating, as you can see there in the second row. And the last one I'll talk about is just the exchange rate, that we do still see a further room for depreciation against the US dollar. There are just too many domestic issues in South Africa that's weighing down on the rand. Interest rate hikes have not been successful in maintaining a strong rand against the US dollar. So we really do see that on a downward trend for the next couple of years. And I think that will then also be the risks to our inflation outlook. It is a positive story and a positive picture, but that still doesn't mean that there aren't any risks. We still need government to create a more pro-business environment for private sector to really take over. We can't have government being 60-70% of GDP. But for that to happen, your policy environment needs to be right. And we're still sitting with NEIP and the Namibia Investment Promotion and Facilitation Bill that's not investor friendly, that is not conducive to business or private business. So there are still those issues that we really need to work on. What you might have also noticed is I've hardly mentioned gas, oil, and green hydrogen throughout my presentation. I did that specifically to show you that there's a lot of other positives going for us. For our economy, besides these mega projects. Obviously, if they are realized, then that will just add on to the positive story that we have, or the positive outlook that we have at this point in time. But I purposefully did not talk too much about them to show you that really, besides them, there is momentum in many other sectors that can also make us positive on the very short to medium term economic outlook. So with that, that's my story for this morning.